I hope all of you are doing absolutely great. The weather is changing, and so is the health of some of us. So I hope we're all taking good care and nourishing ourselves well. I would like to share some thoughts on the markets post policy. And of course, because all of us or most of us would have already gone through the policy and its implications, but it's worth reiterating a few things. To start with, the policy or the RBI MPC was, in terms of outcome of 50 basis points rate hike, was largely in line with expectations. What really was not in line with expectations is the markets expected a slightly dovish undertone. Now, that was not accompanying the statement of the policy, and therefore the markets went into a little bit of a disappointment and sold off. And quite a bit of build up to that had already happened sometime towards the end of July, as the policy happened in the first week of August. The RBI remains non-committal in terms of the future quantum of rate hikes, clearly and rightfully so, because there are too many sum of moving parts. There is a crude oil which is important to be tracked, as we are net importers of crude. While crude has visibly inched lower from what we saw in the last policy to the current policy date, north of $115, $120 to south of $100, it still hasn't shown any signs of stability. Intuitively so, the FY 2023 inflation forecast also has not seen any tweak as far as the year end goes. Of course, small tweaks on the quarter-on-quarter numbers have been done, but that's more so to reflect the current commodity pack sentiment. So I think it's important to note, therefore, that the inflation fight continues, as was articulated by the RBI in their policy statement. The FY 2024 forecast on inflation, however, is way more benign, and that also in some sense ties up with what we are seeing globally. For example, the US CPI, in terms of outlook or in terms of expectation, seems to be showing a decelerating trend. And again, in that same context, the expectation that the US Fed will actually start looking at rate cuts early in 2023 seems to be gaining more momentum. However, the rate hike process, which has already kicked off, looks like will continue into the near future. Even if you look at our bond markets closer home, and if you look at the swap curve, which is the overnight index swap curve, look at the 1 year OIS on May 1st. It was close to 6.2%. Where is it trading today? After 100 basis points of rate hike, it is pretty much trading at around the same levels. What is it indicating? It is basically suggesting that incrementally, the rate hikes are getting discounted, number one, which is something that we have been maintaining for quite some time now. And second, most important thing, that from here on, incremental rate hikes may be quite muted. So in line with that, we are at 5.4% on the repo rate, the benchmark repo rate. Going forward, we expect the terminal repo rate by March 2023 to reside somewhere in the vicinity of about 5.9%, which means at least another 50 basis points between now and the financial year end. Will it happen in one tranche, one go in September end? Could it happen in two tranches? Well, that is best left to each of our imagination right now. It's too soon to call a number of 25 or 50. Much would be seen once the narrative from the US is clearer. The payroll data in the US has been very, very strong, way above expectations. That also is receding the talks of the possible recession that the globe has been talking about. So I think, therefore, as I said, the situation continues to remain pretty fluid, and therefore policy makers cannot really give precise guidance, except for the fact that the northward movement of benchmark rates are set to continue. What should investors do in this kind of a market scenario? Well, again, this is something which we have been stating for quite some time. Please continue to allocate your monies into fixed income. Look at a combination of target maturity funds, which largely tend to buy assets in line with the maturity date of those respective schemes, and therefore allow you to mitigate interest rate risk and offer some stability to your portfolio. Also, do consider allocating money to actively manage funds like the dynamic bond funds and the gilt funds and the bond funds, purely from the fact that if we are towards the higher end of the rate corridor, it does make sense to start allocating, as you may not be able to time the precise rate from an entry standpoint. So staggering your investments into these categories, and of course having some allocations into the 1 to 2 year duration bucket to take advantage of that short term rates which are at elevated levels, allows you to find a nice skew to your portfolio, and also allows you to withstand volatility, which may be the order going forward. In no case we are really of the view that one must wait out before allocating money to fixed income. So the next best option is to continue to stagger. Keep a watch out, of course, on the global trends and commodity prices, which of course will be embedded in portfolios, especially in the funds which are actively managed. On that note, take care. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.